Do you want to know everything about business loan requirements and how to qualify for funding? Then stick till the end of this video. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. Today, I want to talk to you about business loan requirements, how to qualify for funding. Business loan requirements may vary by lender, but a few things remain common across the board. Small business loan documents require three types of substantiation: personal, financial, and legal. So in today's tutorial, I'm going to elaborate on the most common business loan requirements and show you how to qualify and qualify for and apply for a small business loan. So get ready to take some notes, folks. First thing first, you want to think about time in business. So every lender will ask you how long you have been operating. They want to know. So the longer you've been in business, the better it is for you, because your application will, the prominence of your application will increase. It shows the lender that your business has had long-term success. Ultimately, the threshold that you should keep in mind is 2 years. So if you've been in business 2 years, that's a good start. So if your business is under 2 years old, it doesn't make it impossible to get a business loan though. It just limits your option. Number two, personal credit score. One of the most important business loan requirements you'll need to qualify for financing is your personal credit score. So lenders will ask for your personal credit history, financial information, all that kind of stuff, because they want to evaluate the probability that you will pay back your loan. So if your personal finances are strong, lenders assume this means you'll be able to manage your business finances as well. That being said though, your personal credit score will not influence whether or not you're approved, but it will also play a role in determining your loan interest rate. So the great thing here is that you want to aim for a credit score of at least 600 and ideally even higher, especially if you're looking to qualify for a bank or SBA loan. SBA stands for Small Business Administration. Number three, business credit score. So similar to the way your personal credit score indicates your history as a borrower, your business credit score measures your business's credit worthiness. So your business credit score is based on your business history of payments to suppliers and lenders, and it also has some relationship with your business's industry, size, and revenue. Those can also impact the score. So many entrepreneurs are unaware that their business has a credit score. They do. The business, every business has a credit score. And it's common small business. It's a common small business requirement, loan requirement. So there are three main agencies that track business credit. You just got to know that. And each of them has its own method for evaluating your business credit score. So you have Dun & Bradstreet, you have Experian, and you have Equifax. Number four, annual business revenue and profit. This is another requirement for a business loan. So your business's annual revenue and profit will also be one of the most common small business loan requirements you'll see across different lenders. Typically, lenders will want to see both a year-to-date profit and loss statement updated within the last 2 months, as well as statements from the previous 2 years. So they're trying to track 2 years or 2 to 3 years of operational history to see what's really happening. Now, having said that, overall, banks will want to see that your business is profitable in order to approve you for financing. Alternative lenders, on the other hand, will not often require profitability, but will usually have annual revenue minimum. The next thing that lenders want to see is the bank statements. So lenders want to see, they will use your bank statements to determine if you can afford your loan and will be able to pay it back. So bank statements can also give lenders some insight into how well you manage the cash coming into your business. Think about it, right? They want to make sure you are financially responsible. Therefore, at a minimum, lenders will usually ask for 4 months of business bank statements to support the claims you're making about your company's financial history. If you're applying for an SBA loan or a conventional bank loan, you should be able to gather all your documents and be prepared to provide even more bank statements. I'm talking here 12 months, not just 4 months, 12 months, 9 months. Number 6, personal and business tax returns. So just like your personal and business credit scores, lenders will use your tax returns to evaluate the health of your personal and business finances, and therefore your ability to pay, the ability to first afford and then pay back a business loan. So generally they want to see 2 years of your personal tax returns, 2 to 3 years, and this document will be especially important if you have a pass-through entity. Either it's a sole proprietorship, a partnership, an S corp, right? Where you report your business profits and losses on your personal tax returns. So this being said, your business tax returns will be particularly influential if you have, let's say, a corporation, for instance, or an LLC, a limited liability company that is taxed as a corporation. In these cases, your lender will use your last 2 years of business tax returns to verify a few things, including revenue, profit, and expenses. Those are profitability metrics. The next thing they might require is the loan purpose. So a business loan requirement that is important is the loan purpose. Why do you need the money? Is it because you have a temporary liquidity crunch? Is it because you have working capital needs? So this may seem obvious, but a typical small business loan requirement will be a statement describing what you plan to use the loan funds for. So in this statement, you will want to be as specific as possible, because generally lenders allow a variety of loan uses, but they want to make sure that the amount of money you're requesting matches up with the purpose of the loan. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We are still having a conversation today about business loan requirements, the things that you need to have ready before you apply for a loan. And if you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you can be informed in real time whenever we drop a new show. And guess what? We drop this kind of shows every single day. Rain or shine, rain or shine. Like this content, share, and comment below. Ask questions. We answer all questions that are pertinent to the topic discussed. Requirement number 8, loan amount. So this is directly related to the loan purpose. So you'll need to also specify your loan amount. In other words, how much money you want to borrow from the lender. Generally, banks have access to the most capital and can issue loans that are 6 and 7 figures. Therefore, if you need a smaller amount of money, less than $250K, for instance, banks will usually not be the best route. For smaller amounts of funding, you'll likely want to turn to alternative lenders, and in some cases, SBA loans. With this business loan requirements, it's kind of critical to be straightforward and clear about how much financing you'll require, as well as how you will use it. And of course, you don't want to ask for more than you can afford. A business plan is also kind of important. Now, the business plan or a loan proposal will not always be on the list of the small business loan requirements, but it will be for some. For traditional term loans and SBA loans, for example, you will definitely need to provide a business plan for funding. So within your business plan, you'll have an opportunity to lay out both your financial goals. Here I'm talking about future sales, income, profit, cash flows, and your qualitative business goals. So you want to use this document to show your lender that you've thought about all the potential opportunities and challenges for your business and how you're going to grow a successful company. You also need to include on your business loan application the industry. So your industry can affect your eligibility to get a business loan before even applying. Why? Because every industry has a different level of risk. Banks maintain a table of industries, matching those industries with the risks. So most lenders have certain industries that they won't lend to, such as firearms business and adult entertainment businesses that could impact the lender's reputation. However, some lenders also have less obvious restrictions. For instance, some lenders bar child care businesses, healthcare businesses, law offices, apparel companies, and financial companies. Therefore, in order to ensure you'll meet a lender's industry requirement, you want to check with them regarding any ineligible industries before submitting your application. So make sure also that you have correctly identified your business's industry in your loan application, because a small mistake, guess what, could delay your application or even cause the lender to mistakenly reject it. So there are two main industry code systems. You have the standard industry classification, that's the SIC, the SIC, and the North American Industry Classification Systems, the NAICS. You can actually go to the NAICS website and look up your code. So it's NAICS, NAICS.com, www.naics.com/search. Next important requirement is the entity type. So this is kind of simple, but you have to put it. A lender will likely ask you to report your business entity type. So from your lender's perspective, knowing how your company is organized can give them insight into how you manage and operate your small business. Additionally, and this is kind of rare, but it's some lenders will not lend to sole proprietorships and partnerships. It really depends on the lender's experience with that kind of legal structure and their own internal risk management system. So lenders who will not lend to sole proprietorships and partnerships would prefer working with LLCs and corporations because those businesses have more legal protections and are less likely to fold if the owner faces a lawsuit or a financial setback. Business licenses and permits. That's another requirement. So another common business loan requirement is your business license or permit. Although business license requirements vary by state and locality, lenders will want to see your proof of ownership and license to operate a business. Additionally, depending upon the size, location, and type of business, you may also need to provide proof of any relevant fire permits. That's kind of important, very important. Sign permit, zoning permissions, environmental, sales tax, and health department permits. Employment identification number, the EIN. This is another biggie for when it comes to a business loan application. You may not need an EIN for every business loan application or for your business, depending on your entity type. But you should specify your EIN on an application if you have one. Overall, an EIN is like a social security number for businesses. So the IRS uses this unique 9-digit number to track your business's tax returns. So you can quickly and easily apply for an EIN on the internet. And once again, although this number may not be required for all businesses or all loan applications, it may be worth getting one nonetheless. Proof of collateral. That's another requirement that you might have to have on a business loan application. Collateral is not always required, but you may be asked to put up a fixed asset like property or equipment to secure your loan with the lender. So therefore, if you default on the loan, the lender can seize your collateral and use it to make up for some of the money they've lost. Not all lenders will require specific collateral. However, if you're applying for an SBA loan or bank loan, for example, lenders will want to know what kind of collateral your small business has to offer and the value of that collateral. That being said, although alternative lenders typically will not require physical collateral, they may require security in another form, such as a personal guarantee or something called blanket lien. Another requirement that you need to put on a business loan application is balance sheet information. So in addition to the other financial information I've already talked about, many lenders will want to see your balance sheet as part of their small business loan requirement. So like your profit and loss statements, your balance sheet will help show a lender how your business functions and whether or not your financials are in good standing. Essentially, a lender will want to use your balance sheet to see what you have, to see that you have enough assets to cover your business's operating expenses and pay back your loan on time and in full. Therefore, you should have your year-to-year balance sheet and the last 2 years of balance sheet, if you have been in business that long, ready to go as part of your application. Just kind of quickly give you I would say a basic explanation here. A balance sheet just shows your assets, which are like whatever your company owns, and your liabilities, whatever your company's owes. That's as basic as that. And you want to have a positive balance sheet. In other words, you want your assets to be way larger than your liabilities. Another requirement is a copy of your commercial lease. So if you have a brick and mortar business, you should include a copy of your lease along with your other commercial loan documents. So a commercial lease proves that your business will be able to use the property for as long as the duration of the lease, no matter what happens to the landlord. And it also reassures your lender that you'll be able to conduct business to pay back the loan. Disclosure of other debts. You want to explain or reveal to the lender if you have other liabilities, other financial obligations out there. So this is called business debt schedule. That's on the application. So small business lenders are very careful about lending to business owners who already have other loans, as they don't want to offer you financing if you cannot afford your current loan payments. And for this reason, you might be asked to provide a business debt schedule as part of your loan application. Having said that, to evaluate whether you can afford a loan, lenders often calculate something called your debt service coverage ratio. We'll cover this ratio in another show. But basically, this ratio illustrates your current debts and interest payments in relations to your current income and cash flow. So if your DSCR, your debt service coverage ratio, is not high enough, guess what? The lender may reject your application or ask you to reapply later if you have further paid down existing debt. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We're also having a conversation here around the business loan requirements you need to be aware of before applying for a business loan. Number 18, the next one is accounts receivable agent and accounts payable agent. One of the more common bank loan requirements is current AR, so account receivable, and AP agent report. AP standing for accounts payable. So AR and AP agent reports show a lender how efficient your business is at receiving payments for goods and services and paying bills of its own. So the AR report indicates the number of invoices you've sent to clients that are overdue and the length of time by which they are overdue. So this is kind of like a risk management tool for lenders. If the AR report shows too many accounts, it means your business hasn't been very effective at collecting payments. On the other hand, if your AR report shows few overdue accounts, it means your repayment collection efforts are effective. And it also shows that you extend credit to the right kind of customers, and your customers pay off their debt quickly. The AP report is the opposite. So it shows the number of invoices from other businesses that you haven't paid. So a high number of delinquent accounts indicates that you're not good at managing your expenses. You ideally will want to have a low number, or zero for that matter, of overdue accounts on your AP reports. Ownership and affiliation. That's kind of important also for the lender. So when you're applying for a business loan, you should be prepared to disclose any ownership that you or your partners have in other businesses, as well as any other affiliations. I'm talking, for instance, if you are on a board, or you are a consultant in another business, you want to disclose that, because this information can reveal potential conflicts of interest that the lender may have with issuing the loan, and any synergies that your business may have with other companies. Having said that, it can be more difficult to apply for a loan if your business, for instance, has multiple owners. Think about that. So different lenders have different rules on how many owners they need to approve a loan request. So if you take the SBA, so the Small Business Administration, for example, they will check the personal financial information of anyone who owns 20% or more of the business and requires, that's the SBA I'm talking about here, they require a personal guarantee from all of these owners. So other lenders may require approval from just 50% or 70% of overall ownership. So with this in mind, anyone who needs to authorize the loan will need to provide a copy of their photo ID, a resume, a personal credit score, and other personal financial information that the lender requests. Another important requirement is legal contracts and agreements. So this is one of the most common business loan requirements. You will need to provide legal contracts and agreements that your business already has. So along these lines, lenders might want to see any of the following: contracts with major suppliers or other third parties, corporate bylaws, LLC operating agreements, partnership agreements, franchise agreement, sales agreements, financials, and information about the business you are purchasing, if you're using the loan to buy another business, commercial real estate purchase agreement or equipment purchase agreement if the loan is being used for purchasing commercial real estate or equipment. Let's talk now about how to qualify and apply for a small business loan. We had a rundown of all the 20 major business loan requirements. Now let's talk about how to increase your chances of qualifying for a small business loan. The list that I just gave you may seem overwhelming, depending on your lender, you may not need every one of these qualifications for your business loan applications. I just gave you an exhaustive list, but your lender might require probably 10 or 15 criteria. So ultimately though, because small business loan requirements are so variable, it is quintessential to consult a lender about their process before actually submitting an application. That way, you'll be prepared ahead of time to gather any documents or information you'll need to submit, and therefore optimize the process and hopefully increase your chances for approval. With all this in mind, let's just have a conversation around the basic steps you will want to follow to access a business loan. So you need to determine why you need a loan. You need to determine why you need a small business loan. This is very important. You want to calculate how much debt you can afford. Next, you want to compare your loan options. You want to gather loan documents and paperwork, and then apply for a loan. The thing here is that to qualify and apply for a small business loan, once you are able to go through all the 5 steps I just gave you, and you have the requirements that the 20 or so requirements that I just spoke about earlier, you are by default increasing your chances of applying for your chances of qualifying for a small business loan. But the bottom line here is that at the end of the day, as you compare your options and search for the right business funding solution, you want to remember that banks and SBA loans will require the most documentation and highest qualifications, but it will also offer the most desirable rates and terms. This is a win-win for you. So you are submitting as much info as possible, and in return, you're getting the best rates, the best terms, and the largest possible funding amounts. Alternative lenders, on the other hand, they will have simpler application processes and more lenient qualifications, but their products will generally have shorter terms, 1 or 2 years, for instance. They might give you lower amounts and higher interest rates. So this being said, although the qualifications you need to meet will be specific to the loan product and the lender, by understanding the most common business loan requirements that I've spoken about, you'll be in the best place to gather the necessary documentation and quickly and accurately complete your loan application. All right, folks, this is it for today, and thanks so much for listening to today's show. Really appreciate it. I will see you next time, but until then, remember, stay marvelous.